Welcome to this week's market update, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead to the Federal Reserve's crucial interest rate decision happening next week. Let's start with what moved markets this past week. The most telling signal came from corporate America itself, where the largest companies are making a bold bet on where interest rates are headed. Corporate treasurers at giants like Amazon and Uber have been moving billions of dollars out of short-term money markets into long-term bonds, with cash allocations dropping to their lowest level since 2018. They're extending their bond portfolio durations to the longest level in 3 years, essentially trading liquidity for higher yields before interest rates fall. This is insider knowledge in action. The people managing the most money believe that rate cuts are imminent. When corporate America takes this approach, it's making calculated decisions based on the economic outlook. For our portfolios, this validates our strategy of maintaining meaningful bond positions and considering longer duration investments where appropriate. The bond market has been celebrating this shift, delivering its longest winning streak since February. 10-year Treasury yields dropped to 4.04% after touching 5-month lows, with a 25 basis point cut fully priced in for next week. What's encouraging is how bond investors are looking beyond individual data points to focus on the bigger picture. Even mixed inflation reports haven't derailed the rally, indicating confidence that the Fed can strike a balance between supporting growth and maintaining price stability. This creates an attractive environment for bond investors. Current yields remain appealing, while there's potential for additional gains as policy evolves. Meanwhile, cash investors face a new reality. With over $7 trillion in money market funds earning 4% plus yields, those attractive returns are about to diminish once rate cuts begin. Strategists from UBS and BlackRock are warning that keeping too much cash could become costly. The message isn't panic. Cash still serves important purposes for emergencies and short-term needs. But for long-term returns, smart investors are exploring alternatives from treasury funds to balanced portfolios that can sustain income even as rates fall. This creates opportunities for those willing to move beyond cash. Now let's examine what drove our strong performance over the past week and why we remain confident in our strategic positioning. Tesla was our top performer with an impressive 5.83% gain, showcasing why we maintain our position in this innovative company. The stock surged on growing optimism about global electric vehicle demand and Tesla's expanding product roadmap. While valuations do remain elevated, Tesla attracts institutional investment because of its leadership in EV, expansion into autonomous driving, and energy storage. What makes Tesla valuable in our portfolios is its exposure to multiple long-term trends: sustainable transportation, artificial intelligence advances, and energy independence. The company's integrated approach from manufacturing to software creates competitive advantages that traditional automakers struggle to replicate. This performance validates our view that Tesla represents more than just a car company. Information technology dominated our portfolio performance, with nearly every major holding contributing solid gains. Broadcom soared over 13.41% on strong AI and cloud infrastructure guidance, while other semiconductor leaders also posted solid returns. We are seeing accelerating demand for AI infrastructure, government incentives for domestic chip production, and growing confidence that established tech leaders can navigate policy changes effectively. Our technology companies possess exactly what matters today: substantial cash generation, technological advantages competitors can't match, and resources to invest in next-generation innovations. Despite higher valuations, we believe long-term growth potential justifies our allocations. These are profitable companies with proven business models essential to the modern economy. Our size strategy delivered outstanding results, with large cap holdings significantly outpacing smaller companies. Mega cap leaders like Tesla, Nvidia, Apple, and Alphabet all posted impressive gains, while our Canadian banking position, Royal Bank, also contributed strong returns. During uncertain times, investors naturally seek larger, established companies for good reason. These businesses have financial strength to weather storms, global reach to capture opportunities, and resources for cutting-edge technologies smaller companies cannot afford. They navigate complex regulations and adapt to policy changes better than less resourced companies. While some worry about concentration risk, we see outperformance as earned through superior execution and competitive advantages that deliver consistent results. Looking ahead, next week brings the Federal Reserve's highly anticipated interest rate decision and other key events that could shape market direction. We'll start by talking about the August retail sales data coming Tuesday, September the 16th, which will offer fresh insights into the consumer behavior amid economic uncertainty. July showed a healthy growth of 0.5%, led by strong auto purchases and online shopping. Next week's report will reveal whether momentum continued or if consumers began pulling back. We'll focus on the control group measure that feeds into economic growth calculations. Strong sales would reinforce our view of resilient consumer spending, supporting companies with competitive advantages. Weaker sales, however, might indicate households are feeling the cumulative cost pressures. Either way, this data provides crucial context for the Fed's decision and helps assess which consumer investments are best positioned ahead. The main event is the Federal Reserve's two-day policy meeting that's going to conclude on Wednesday, September the 17th, which markets widely expect to be the first rate cut since December. With a quarter-point rate cut next week fully priced in, this decision marks a pivotal shift in monetary policy. Fed Chair Powell's press conference after the announcement will be crucial, as his comments about the future rate cuts will set expectations for the rest of the year. The Fed faces a delicate balance, supporting a cooling labor market while making sure inflation stays on track towards its 2% target. For investors, a rate cut would likely boost both stocks and bonds, while Powell's future guidance could determine market sentiment through year-end. Lastly, Thursday's jobless claims report will be particularly important given the Fed's focus on employment trends. Recent claims data has shown some volatility around 263,000, and we'll watch for signs that businesses are reducing staff more aggressively due to the economic uncertainty. With unemployment having edged up to 4.3% recently, weekly claims help us spot trends before monthly reports. Strong employment supports consumer spending and corporate profits, making this crucial for understanding economic momentum. Stable claims would support the Fed's measured approach, while significant increases could pressure more aggressive easing. As always, we remain focused on what matters most, helping you achieve your long-term financial goals through disciplined investing and thoughtful portfolio management during this pivotal moment for monetary policy. Thanks for joining us, and we'll see you next week.